financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to Your Money, Your Call. I'm Kim Slater. If you've got a question about shares or the market in general, our phone lines are open on 1300 30 34 35, or if you prefer, you can email us at yourmoney@skynews.com.au. So welcome to the program. Tonight we have with us David Novak and our stalwart Ben Clark. Gentlemen, today was the day that non-believers had to become converts. The market comprehensively broke through 5,000 points off the back of the CBA bank numbers. And yes, it is expensive and defensive, but those numbers that CBA produced could not be faulted. And you know, when you look at it, you can't see any material sign of asset deterioration, and whichever way you look at it, the CBA balance sheet is in rude good health. Your take on the market's reaction to CBA today, Dave?
Oh, look, it's a great result. In fact, I've got to say, I've taken a contrarian view here, and I've actually shorted CBA today in the morning. So I like it. I like the result. The result was fantastic. But after this run up here, I'm looking for a short-term pullback, especially running into the div period. But nothing wrong with the result. I'm just taking a short-term short position on such a run up here and a big gap up. But the result was stellar. And, you know, it's the market certainly, I'm getting a bit dizzy up here, so I've got to take my blood, my tablets for my high blood pressure while the market's run up here 13 weeks in a row. and you know, I'm nearly stepping over the line to become, as you said, converted. Yeah. I'm not quite there yet. So, you know.
Well, I mean, today was my, conversion on the road to Damascus, if you like, because when you looked at that result, what the market did through 5,000 points. I mean, really, when you start looking at the reporting season, okay, some of the results have been a little bit ordinary, and I'll be interested in your take on this, Ben. But generally, the sentiment that's being displayed towards the results season has been pretty good. So, I mean, everyone's more or less being dragged and kicking and screaming to the table, saying, if you don't get in now, you're not going to get in. With a result like that, I can see that the market's firmly on a track now towards something like 6,000 points, barring, of course, something major not happening overseas. What's your take?
Yeah, look, I think the reporting season's been really encouraging. I would say, though, there hasn't been a lot of movement at the revenue line. A lot of it's been due to companies being, I think, ruthless on costs for the last few years. So, there's been small ticks-ups in revenues, but that's had quite a marked impact on earnings, which is encouraging, because if revenues do start to pick up, over the next 6 to 12 months, then again, earnings are going to, sort of really move. I think today was a bit of a mixed bag for me in terms of the results. There were some good ones, and there were some ones that have a lot of work to do in the second half to meet their guidance. But generally, I think the stocks that have had great runs and really needed to deliver, otherwise they were going to get smashed, have managed to do that, and that's companies like Telstra and Commonwealth Bank. And then the companies that I think everyone's been pretty nervous about, like Newcrest, Bradken, some of these mining services stocks, have delivered much better results than forecast. And you've seen JB Hi-Fi, you've seen these big short covering rallies occurring. So, I think there's money pushing into the market. The shorts are buying back stock. Earnings look better than we thought they were going to be. So, I do get a bit nervous when everyone's getting quite so bullish. I think we need a pullback at some stage. It's healthy for the market to have a pullback. Well,
what's healthy and what actually happens usually are two different things.
Yeah.
I mean, because, for instance, with some of the figures I've seen this week suggesting that there's potentially as much as $300 billion in term deposits there that could, rotate at some point out of term deposits into the equity market. And if there was ever a call to arms for mums and dads and self-managed super funds to get into the market and buy equities, that was that CBA profit amount or that CBA dividend today. You can see that the tabloid headline tomorrow is 20-point or 50-point bold headline. CBA dividend up 20%, and everyone's going to go, my God, if we don't get in now, it'll be the fear of missing out.
Yeah. And that's always a feature. I mean, David and I were saying off screen earlier that I think there is a lot of money that has missed this rally, and therefore I don't think the dips will be too pronounced, because I think there's lots of people who are keen to get into the market. So you don't expect too much on the downside. But yeah, and the other thing is, you look at a lot of the fund managers, and they're all getting inflows for the first time in 3 or 4 years.
Yeah.
So fund managers are actually being forced to buy for the first time, in that long.
Well, that's exactly when all of a sudden, if your cash allocations are going up, you can't afford to say no. I can't. I won't invest in the market.
Yeah.
Interesting today, that consumer confidence survey, 7.7% in February. I sort of sat back and thought, what's going on here? That looked looked a bit weird.
Yeah, it doesn't make much sense when you consider the retail sales have been negative for, I think it's 3 months in a row, and
yeah,
unemployment has been pretty steady, but job ads have come down consistently over the past. ANZ job ads have come down consistently over the past few months, and so yeah, it's quite one out of the box. Didn't expect that one.
Is that something that's going to make you turn around? And we've been discussing retail stocks, and I think last week I was suggesting that I could smell a bit of a bargain in Myers, but do you reckon there's enough happening in that sector to entice investors back into it?
I definitely think there is. I'm not touching it, because I think one thing, you've got to be really disciplined if you are putting money into the market at these levels about the companies you buy. I would hate to buy Myers now and then there is a pullback and Myers comes back 10-15%, which it easily could. And then you're looking at it thinking, why did I buy Myer? It's not a stock I want to own longer term.
True.
So, but these are still, I think, JB Hi-Fi, they reckon, has 30 days of its average turnover is still short. So these things could go a lot further than fundamentals sort of say they should.
Yeah, but well, sorry.
Yeah, when you're in a bull market, when you get downgrades in earnings or net losses and the stocks go up, you know that.
Yeah, the market's looking through that and over the horizon.
Oh, absolutely, and that's what's occurring right now.
Okay, well, let's go to our first caller, who's Helen. Helen, welcome to the program. Helen, are you there?
Yes.
Hi, how are you going?
Good, thanks.
That's good.
Look, I'm ringing about two different stocks, Collection House and 10 Network. Collection House came to my attention on one of your shows, actually. Somebody rang, it was at $1.17.
Yep.
Put it on my list and watched it, and kept going up, and I finally worked up the courage to buy it at $1.40. Last week, and it was $1.60 today, and it just keeps going up. They pay fully franked dividend and so on. So I was just wondering if it's got more legs, and of course Channel 10, to see if it's worth taking a bit of a punt and on Channel 10 with just about 10,000 shares or something.
Well, it's an interesting one, Channel 10. I think that someone described Channel 10 to me as having enough scrip on issue to wallpaper every lounge room in Sydney, because there's something like 2.3 billion pieces of paper on issue. But you can see the two charts there. First of all, let's deal with Collection House, because that's an interesting one. You've had a look at that, Ben.
Yep.
And what are your thoughts? Helen's bought it at 140 to 160. It's like everything climbing the side of the Matterhorn. You'd stay in for the ride.
I met actually a good mate of mine who's a great broker. He brought the management round to see us probably about 6 months ago when it was 85 cents.
Yep.
And I thought I liked the sound of it, but didn't touch it, unfortunately. And I've been kicking myself, and he's been reminding me ever since. Look, Collection House has had a great set of results. Of course, it's the junior player to Credit Corp, which is also having an incredible run at the moment. It's nearly trading at $10. These sort of companies buy distressed loan books from the banks and then try and get back more revenue or more of the payouts, things like credit cards that are overdue, than they paid for them. They're moving into America, both of these companies, I believe. And I don't think the stock looks particularly cheap anymore, and I would be very careful about buying it at this point.
Above $1.60.
Above $1.60, yeah. I've seen valuations up to $2 on it, and I saw Perpetual went substantial in it a week or so ago. So there's obviously something there like that.
That's an interesting sign.
Yeah.
What are your thoughts on this Collection House?
Well, I actually like it. Actually, a mate of mine who's probably watching tonight, Rick, he bought this when I told him a few years back, and then after he bought it, it went down. So he's now made his money back.
Isn't that always the way when you give tips to friends?
Yeah.
So he's very happy at the moment. And he asked me just actually this week on Monday, what do you think of Collection House? I'm back to above break even. And I said, well, mate, it's got a pretty good yield. You know, it's still paying, 4 or 5% fully franked. It's got some good earnings growth, 17% average, good return on equity. So no reason to sell it and hold it for the dividend. But after saying that, maybe he should take some profits right now.
Well, that's the position that Helen's in. She's long at $1.40, it's $1.60. It's always tempting to take something off the table, but with the momentum in this market, you've really just got to cross your fingers and watch. I mean, my advice would, if it got to $1.70, Helen, I'd start to dribble a few into the market. But the other interesting one is 10. I mean, this has been a bombed out situation for forever and a day. Is there any hope in this one? What do the technicals look like in a day?
Oh, look, they're almost off the chart, so I don't think it goes low enough. It's actually
under the table somewhere, is it?
Look, the trend here is just shocking since 2010. From the highs there, about 148.
So it actually hasn't bottomed?
No, it hasn't bottomed at all. I mean, I'm looking at the chart here, it's still trending down. So look, I can't get excited about it, and the earnings just look terrible. So, negative? Well, there is no earnings. It's pretty negative. Yeah. So, look, it's
our golden-haired boy here, I reckon, is a prime candidate for what was it, MasterChef or something like that on Channel 10. I mean, he's pretty desperate for the old kitchen knives. Anyway, all right, Helen. Best advice is stick with Collection House. Perhaps start to take some profits at maybe $1.07. Channel 10, give it a miss. Our next caller is Abe from Sydney. Welcome to the program, Abe.
Thanks, Kim, for taking my call. I've got a couple of questions to ask the panel. One is about Newcrest. Does the panel believe it will be re-rated in view of the recent report? And which way is gold heading in this environment? And also a general question about oil stocks like Oil Search and WPL and Santos in view of what's happening with the shale gas in the States. Do you think that it's better to get rid of those stocks before they get hammered by the flood of cheap energy?
Well, Abe, we've just about covered the whole investment spectrum of those questions tonight, so we'll do our best to try and throw some light on it. First of all, gold price looks like it's locked into a trading range, and it could go. It's a bit of a bet which way it's going to go from here, and I really don't have any idea. What are the technicals telling you?
Oh, the technicals clearly say it's going down, especially if it breaks 1632 US. That would be breaking below a previous low, which would not be good, but it's certainly trending down on the weekly and the daily chart. So, 1632 is a key line. If it breaks below that, I mean, this thing could go back and test the 1550 lows.
Okay. Well, Newcrest has come out and, they've had a production re-rating and the share price has rallied. Is this the return to the good times for Newcrest, Ben? Can it get back up into the 30s, or are they going to, when we least expect, deliver us another, hit over the head with a wet fish?
Newcrest has been a real challenge because it really never caught much of the gold price rise the last couple of years. I think I definitely agree with David. The outlook for gold is very unclear at the moment. Gold does trade very technically, so you have to keep a close eye on it. And I actually caught up with a mate who is a gold trader, and he was saying the next couple of weeks are critical, he reckons, from a technical point of view as to which way he reckons it's either going to gap up or lower. So, I think Newcrest, in Newcrest's favour, they've reached the end of a very intensive capital expenditure couple of years, and the reason why the result, I think, was well received was the management was saying we're going to have a lot of excess free cash flow over the next 3 to 5 years that we haven't had previously. Dividends are going to start to rise. We're going to start to look at the balance sheet, etc. At 1550 even, gold is still at a very profitable price for Newcrest to dig up. It's almost like the market has factored in that's happening, but of course it won't stop the share price falling if it does happen.
No.
So I still think it's worth having it as part of a portfolio, but it's got its place, I still think, but you wouldn't want to be sort of heavily overweight it by any means.
Okay, well, I think we'll have to come back after the break and try and answer Abe's question on oil and gas. So it's time for a quick break, but before that, though, it's time to start the Stock Watch. Ben Clark, what are you watching? And your time starts right now.
We've been recently adding or buying ResMed. ResMed's been a great stock for us over the last year and a half. They reported an incredibly good result, well ahead of market's expectations. It's since pulled back on the back of some changes that the US is doing on subsidies for medical devices. But we think the management will be able to navigate that. The earnings outlook is very strong, and trading on a P of about 16 times, I think it's good value.
Welcome back to the program. If you've just joined us, Ben's stock watch was ResMed. Interesting stock this, because the whole health sector has been galloping away and is trading on very expensive multiples, Ben, but this one seems to be, stand somewhat apart from its peers, where its valuation's not as expensive. What's actually created that situation?
I think one of the things is the company pays a very low dividend. It's actually, for years, it never paid a dividend. It's only just started in the last couple of years. So I think there isn't that hunt on for yield that we're seeing in other areas, although most healthcare stocks pay pretty low dividends.
Yeah.
I mean, for us, the healthcare space is still one of the standout sort of sectors. If you're investing for the next 10 to 20 years to fund your retirement, you look at all the statistics around the world about the ageing populations, and the growth in demand for medical products and all the related services is just going to be unprecedented for literally the next 2 to 3 decades. And we think you want to have stocks like this in CSL, Ramsay, Cochlear. We've just recently started buying in your portfolio, because although they do look pricey now, but we think the quality of the business warrants it. Also, ResMed's got 650 million cash on its balance sheet, no debt, so the balance sheet's in great shape. And there's still things it can do on the cost side. They've been talking about potentially, I mean, they still literally manufacture their masks up the road in, near Brookvale in Sydney.
Yep.
And they've been saying they might move those manufacturing facilities to Singapore. It's a stock we've liked for a long time. Sleep apnea is a condition that is being diagnosed more and more widely every year, and there's only two sort of competitors, Respironics and ResMed, in the sector. High barriers to entry, good place to be.
All right, well, we'll watch that one with interest. So if you've got a question you'd like answered, give us a call on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Our next caller from Sydney is Carrie. Welcome to the program, Carrie. Oh, Carl, I should say.
Carl.
G'day, Carl. How are you? Sorry about that.
Not bad. How are you? Hi. Thanks for taking my call.
That's all right.
The stock I was ringing about was my Netphone. Its ASX code is MNF. I bought it when the company was first listed in 2006. In fact, it was the very first parcel of shares I had ever bought in my life. I've bought shares since then, but I bought them 20 cents, and today they closed at $1.30. I've held them since 2006. I haven't really taken much notice of them. They got at some point they got up to $1.32. I just don't know whether I should hold them, rid them, or what. I tend not to sell. I tend to just hold on to everything I buy.
Well, the problem is that if you do hold them and you don't sell, when they do go down the other side of the price curve, you tend not to sell either, and you miss out on every which way. But David was having a look at the chart on these things. So, what's your advice?
Well, look, it's certainly been positive earnings, that's for sure. Huge growth from the year before, so everything looks like it's just going really well for the company. The only thing is it is getting up there, but 23 times earnings multiple. I don't know what the outlook is. Obviously, it must be very positive to be on an earnings multiple of 23. It's on a just under 2% fully franked yield. But look, you know, there's nothing wrong with taking profits on the way up here. So that's what I would suggest to the callers. Take some money off the table. And
it's one where there's not a lot of liquidity in it. So if you had, you know, even a few 100,000 shares, it's something that would take you a few days to actually move a position out into the market, wouldn't it? So,
well, there's 111,000 shares traded average every day.
Yeah.
You know, which is $134,000 worth of stock.
Yeah.
So it's not a big cap, that's for sure.
And what's the market cap on? About 60 mil or something?
The 80 mil
80
is the
mil,
market cap. Yeah. But
Ben, you've looked at the fundamentals on this some time ago. What did it catch your eye at all?
Yeah, we owned it briefly from when it was about 32 cents to about 63 cents we sold out, so far too early in hindsight. The company's grown through acquisition. It made a couple of acquisitions, I think, in 08 or 09 that really paid off for it in 2010. And it's since made a lot more. I think it's actually just closed 3 new acquisitions. I think one thing is you've got to be, I mean, the market's giving it the benefit of the doubt that it'll be able to get the synergies out of these acquisitions and continue to integrate them without, you know, any sort of problems. The only thing I'd be careful of and why you've got to watch it closely is if there's a stumble on those sort of metrics that David's talking about, it could, you know, there could be a fair bit of downside in it pretty quickly, and we've seen that happen in this sector.
Yeah, I know. I was going to say, with all of these, with Telstra supposedly, you know, David Thady driving the customer focus at Telstra, and Telstra, you know, sort of becoming more customer orientated. How much of that is a real danger to these guys?
Yeah, well, I think, but, you know, a lot of them are carving out their niches. You know, you look at TPG and iiNet, and a lot of people sort of said they'd never be able to keep the growth up because Telstra at some stage would squash them. But clearly, you know, if you can carve out an area, and I think My Net Phone does a fair bit in small to mid-sized businesses where companies like Macquarie Communications and MTU have been very strong as well. So, you know, it can work very well when it works. When you're buying businesses on 4 times earnings and you're trading on 23 times earnings, that's awesome.
An instant uplift there, aren't you?
You're getting a good...
Yeah, I should just point out the directors own about half the stock as well. So that's pretty tightly held.
Well, it's always going to be one of those things that it's almost a trade by appointment job, isn't it? All right, our next caller is Bernard from Queensland. Welcome to the program, Bernard.
How you going, gentlemen?
Good, thanks.
Just a quick one. I've been a long-time holder of CSR, and just wondering whether your thoughts with the last 6 months being fairly positive, their share price has moved, where you think they're going, and whether that's positive for them, and if time, KRM, please.
Well, CSR, being a long-term shareholder in CSR would have been a painful exercise, wouldn't it, Ben?
Yeah, it's been pretty disappointing. I mean, look, CSR at the moment is it reports this week, and the result will be very closely looked at because it's another one that I think needs to have some, you know, a bit of a positive outlook and to actually deliver some results that the market's giving it the benefit of the doubt. It's gone through a 6-month period of massive PE expansion on the belief that the demand for building products is rapidly going to pick up, and I think that's quite likely it's going to happen. They've also got a big aluminium division still, and the price of aluminium's been recovering, which would be working in their favour. So, you know, I actually think CSR looks all right at these levels, but obviously it is a lower quality sort of business in the sector, but it's got massive leverage to it. I think, like, the consensus analyst estimate is 41% earnings growth next year, and if it delivers that, it probably looks cheap. If it does 10 or 20, it looks horribly expensive, and therein sort of lies the challenge, and there'll be volatility in the stock.
This is the whole rub about the market, about, you know, what's expensive and what's cheap, cheap at the moment, and that's the elephant in the room that I think everybody's trying to grapple with. CSR?
Well, yeah, I got to say, this sector, the building material sector, including Boral, it just looks so overpriced to me. I don't know what valuation people are looking at, but on my book, it's like trading on a forward multiple of 23 times on 3% unfranked yield. And then we saw Boral come out with a net loss after significant items today. They're on a 35 times earnings. They cut the dividend by 33%, and the stock went up today. So, I mean, I must be missing something, because I look at their result and I read the numbers and I'm looking forward, and they're going, it's going to be a flat year, it's still challenging in 2013. The plasterboards division looks promising in terms of growth in 2014 and beyond for the Asian market. Also, if there's the housing recovery in the US continues going, but please give me a break. I mean, I must be missing something here, but I wouldn't touch either of these stocks.
Well, I think the truism is in this particular sector is it does pay to be counter-cyclical, because if the herd's going one way, inevitably, it's that last 5 or 10% in the market that they're chasing, and that's the time when you really want to be discreetly selling into it.
Well, that'd be prudent. But look, it's a good technical trading stock, but
yeah,
not for an investor, not for my money.
It is like the cyclicals are something you've got to be like, you actually buy them on high PEs and you sell them on low PEs is generally how, when the market's really bullish with its earnings estimates and that they look really cheap, that's actually when you should be selling, and it can be hard to do that. The thing is the building cycle has had 3 of these false starts, I reckon, in the last 5 years, where we thought, 400,000 houses are going to be built in New South Wales, there's going to be big demand, now's the time to buy them, and it hasn't flown through on the earnings cycle. So who knows if this is another false start or if it's really going to kick through.
All right, we'll move on to our next caller, who's Nancy from Sydney. Welcome to the program, Nancy.
Hi, how are you?
Very well, thank you. What can we do for you?
Yes, look, this is primarily a question for Ben. He was suggesting in the past the HA perpetual securities, the NAB ones, and they were about $73. Now NAB has got a new securities that are coming out for $100, and I'm not sure which would be the better one to buy.
Actually, that's a very, very, very good question, Nancy. With that, with these issues of hybrids that are coming to the market, we saw that one NAB's to $750 million today, which is 300 basis points over swap, so somewhere in the vicinity of 6%. But as Nancy was saying, what do? You buy the old series or do you buy the new series?
Yep. Well, they've got totally different characteristics, Nancy, and I'm not going to be able to answer it in a minute or two because these have got a lot of terms to them that you need to be aware of, and really you should, I reckon, always get professional advice with these things because they can have some nasty elements to them. The NAB HAs are a perpetual security that we suspect will be bought back within the next 5 or so years.
Where are they trading at the moment?
About 72.
Yep.
But under the Basel III changes, they're no longer allowed to be used as Tier 1 capital.
So
we think they'll get to a point where they'll be bought back. It's just how long will that take and at what price will they be bought back? So the yield on those is roughly the same as what the new NAB prefs is. They're paying 3.2 to 3.4 over bank. I'm not probably going to tender for the new NABs. I think there's better ones on the market at the moment that you can buy. I'm not going to run through them because some of them we're actually trying to buy and they're pretty illiquid. But sorry, Kim.
I was going to say, but doesn't this raise the sort of issue about investing in hybrids altogether? I mean, my view on these hybrids is the capital's going into the balance sheet, so you're actually better off buying the ordinary shares, the underlying ordinary shares, because it's cheap. The hybrid holders are providing, if you like, cheap finance to the ordinary shareholders.
Yeah.
And it's the ordinary shareholders that are getting the uplift out of this because that capital is going to work on the balance sheet, and if it's done successfully, they get the capital growth and they get the increased dividends, where you as a hybrid holder are just getting a floating yield, and maybe you might get your money back in 10 or 15 or 20 years' time, depending on what the terms of the reset are.
Yeah, I disagree with that because I see hybrids as an alternative to cash rather than as an alternative to equities. And if you take that approach, you're going to end up being 100% invested because you could always say, you can get a better yield in NAB than you can in cash as well.
Yeah, well, in the rising market, being 100% invested.
Yeah, well, that would have been the right thing to do. But, if you've got, in your nest egg, you've got $2 million, you don't want to be 100% invested. On the cash side, you want to try and find options that don't, the thing is they don't have the same equity market risk that NAB shares do. The NAB, whatever they're going to be, PAs or whatever. Yeah. Because NAB's share price has to more than halve. I think it has to drop 60% for you to cop any sort of equity component risk. And that's something that you've got to monitor. But again, look, I think there's better ones that are trading on the market. The NAB HAs, I think, are a bit more unique, so I reckon there's some capital upside in them. But, it's a long-term trade, so don't, they could come back to $67 or something like that. They might run up to 80. We're there because we think 5 to 7 years, be patient, you're getting a good yield during the time. and if they get bought back out at $100, you'll make good money at the same time. But it's not what you could make in a NAV share. I mean, probably made that money in the last 3 months being in NAV.
Correct. I hope that throws some light on what's a very, very difficult area for many individual investors. Nancy, I know we get a lot of calls about hybrids, and when you start trying to explain to people all the various terms on it,
The eyes go.
Oh, you're right. They glaze over and roll back in your head. All right, we'll have to leave it there for a moment while we take a short break, but we'll be back with more. If you'd like to speak with our expert panel, give us a call on 1300 30 34 35 or email us at yourmoney@skynews.com.au.
I'm Ingrid Willinge with a Business Night news update. Well, a stellar day for the ASX 200 today, with the benchmark closing up almost 1% at its highest level since September 2008. It broke through the all-important 5,000 level to close at 5,003 points, helped by a raft of stronger earnings results and also stronger consumer sentiment. The latest Westpac Melbourne Institute survey showing consumer sentiment rose by 7.7% this month to 108.3 points, its highest reading in more than 2 years. It coming after the RBA left the official cash rate unchanged at 3% last week, citing fewer global threats and signs the domestic economy was warming to last year's string of interest rate cuts. And it was a big day for earnings today. The Commonwealth Bank beating expectations, posting around $3.8 billion in first half cash profit, sending shares to an all-time high. The 6% rise in cash profit compares with a 1% lift in net profit for the half of $3.6 billion. Australia's biggest lender will also be paying a higher interim dividend of $1.64. That's an increase of 20% on year. The bank's CEO Ian Narev saying global financial markets are stabilising and domestic consumer and business confidence is improving.
The importance of posting good results really not related to me or my tenure. We've got a lot of shareholders out there for whom our dividend outcome and our performance is important. Obviously for our customers, we want to see signs of a good solid bank. And I think also generally in Australia, people were hoping that there'd be an ongoing sign of confidence and stability. So to that extent, I think contributing to that is important.
And that is all for me from now, but I will be back with those stories in full in Business Night in just under half an hour.
Welcome back to the program. If you have a question you'd like answered, give us a call on 1300 30 34 35 or email us at yourmoney@skynews.com.au. We have, of course, on our expert panel tonight, Ben Clark from TMS and David Novak from Wealth Management.
Wealthwise Education.
Wealthwise Education. Now, I always get that wrong. Anyway, our next call is Richard from Sydney. Welcome to the program, Richard.
Hi, Kim.
How are you going?
Just wondering if the boys could give an analysis on car sales result today. It seems to be overshadowed by all the other bigger stocks. And Ben, I know you're not disposed towards Iris, but I mean, if the market is picking up, don't you think I'm a shareholder in ASX and also Iris? I bought around about quite a few shares on your recommendation, around about $6. I mean, if the market is going to pick up, certainly these stocks should pick up too. Thanks, guys.
Interesting. Which one
Yeah,
do you want
good
to
question.
answer? Which one do you want to answer first?
We're listening to the car sales conference call, and I think the CEO must have said about 5 times we're comfortable with consensus outlook for earnings. So I think, Richard, today there was just a bit of a pullback because I think, Domino's Pizza was another one that I think fell into this category where the market was hoping for a result ahead of expectations or an outlook ahead of an upgrade, and they didn't get it. Car sales have traditionally been pretty conservative when they've given guidance, so I think that's probably still on the low side. But, the stock's had an amazing run and it's trading on a very high PE, so I think it's due for a breather. On Iress, you're definitely right. The pickup in equity markets, I think, will have brokers second-guessing the next round of job cuts that we're hearing loud and clear. We're in the works. I still think it's going to be a while. I mean, the thing for me of Iress and why we took profits on it, and it was around these levels, so it hasn't really done anything since.
Was it trading
about 8.50 at the moment. It's trading on about 21 times forward earnings. It's an awesome business. Really, as we all know, it's totally captured the monopoly in our market, and it's hard to see any sort of competitor getting in there. I just think that on 21 times earnings, it's pricey from a valuation point of view, and I think it's still going to have a year or two where brokers are going to be hesitant to start hiring again, and they're still trying to cut costs. I mean, we're seeing it, so it's definitely happening. There's still guys being let go.
Have you had the call from Bloomberg offering you a cheaper screen yet?
No, I haven't, because pay enough for them.
Yeah, exactly.
They're not cheap. Yeah, so look, I just think for us it was an easy one to take profit on. It's definitely one we would buy back at the right price.
ASX, being a monopoly business, has got, they've been given a window of 2 years. I mean, really, at the end of the day, you can see that this is going to be a business, not necessarily in decline, but when they throw open the doors of competition, definitely the incumbent is going to suffer. Is it really worthwhile being in ASX at these sorts of levels?
Well, I mean, a takeover bid might be on the go again. I mean, we've got a Liberal government probably coming in, and you wonder if they would have knocked back the Singapore Exchange's bid.
True.
Volumes would have to be picking back up. Look, it's not one I buy into because I think it is going through that process of losing the monopoly and losing the premium rating. What do you think, Dave?
What do you reckon, Dave?
Well, it's priced at 18 times earnings at ASX, and I look at the earnings, the average earnings growth for the last 3 years is 3%,
Okay, well, let's have a look at car sales, because this is really the new rivers of gold, isn't it? Supposed to be.
Well, supposed to be, yeah.
Supposed to be. So, where the share price is around that $8 level.
Yeah.
How much more steam is left in this?
Well, I can tell you from a technical point of view, the indicator that I'm looking at here on my weekly is the relative strength index, and it's got what I call a Class A bearish divergence, which means that this thing's going to fall out of bed and go down to $7 is what it's telling me right here. That's the next major support level. But when I see a divergence like this on a weekly chart, it's very bearish, and it means it falls out of bed very quickly. Plus on the multiple, earnings multiple at 27 right now, forward multiple at 24, even though they've had a good result, I mean, this stock has more than doubled in the last year.
Quick reach for the phones, Ben. Put the sell orders on it.
It'd be a good buy at $7, but I tend to agree. Like it is, I reckon it's due for a pullback, and there are things that could cause it. AP Eagers and Automotive Holdings own big stakes in car sales, and I reckon they'd have to be tempted to take some profit. Like a big line of stock could come to market.
Yep.
So I'd like to buy it on a decent dip. I hope it'll be nice if we got back there. I hope you're right.
This looks like a fantastic short, actually. I'll look at this tomorrow. This is
it'll be 10 o'clock. Grab the phones and see who can get the first orders on. Okay, our next caller is Kerry from the Gold Coast. Welcome to the program, Kerry.
Yeah, boys, how you going?
Very well. What can we do for you?
Mate, RCO, I know the market's chasing yield. This is a low cap. The only problem this one is liquidity, but I bought this back in 2009, around 28 cents. Look, capital management, you can't fault it. There are 2 buybacks. They had a takeover, hostile takeover 209, survived. Capital turn of 10 cents. And now they're paying best part of 4 cents fully franked biannual dividend, so 4 cents a year. Got about 36 cents cash in the bank. Market cap now is about 29 mil. But yielding probably now still 7.5% fully franked. My yield's about 13%, so I paid about 28 back in 2009. But way under the radar. Good royalty income from Reefton Gold Mine, and I think the big kick is going to be that Bowden's, the new silver mine with Kingsgate. That kicks off, that guarantees them another 25 million for the next 10 years. Way under the radar, and technically for Dave, I think it's going to break up the old highs at 80. Nice chart, just creeping up. But the big negative is illiquidity. It's a very tightly held stock, and the guys who made the takeover are doing the creep rule. About 34% they've got of the company now. But just thought, thanks, boys.
Yeah, well, this is typical lobster pot, isn't it? You know, if you can get into it, it's going to be hard to get out of.
Yeah, well, that's right. It is thinly traded. 52 million, 53 million issued shares, very, very thin. I do like the fundamentals of it. But it's a very small cap, 5 times earnings multiple, 7% fully franked yield. But it does look good. I like the return on equity. The yield looks fantastic. The trend is moving up, so everything looks positive except for the liquidity side of things. But certainly, it does look like it's heading north. I like it.
All right. Well, look, I don't think you got anything to add there, have you, Benny? So we'll move on to our next caller, who's Andrew from Brisbane. Welcome to the program, Andrew.
Yeah, g'day, Kim. Just looking at Cochlear at the moment, it's come off from $68. Are we going to see? I think it's up to about 70 now. And do we see any lower point?
Good question. We were talking about the healthcare stocks earlier, Ben. Cochlear.
Yeah. We've been buying it the last few days. Only buying sort of an initial stake. I've got no idea if it could go lower. Yes, it could go lower because it is trading still on a PE of about 23, 24 times. This is one of the best quality companies, I reckon, on our market. I've actually been speaking to some people in the area, and from what I've sort of worked out is that the other sort of big player in this market is Advanced Bionics, and they sort of leapfrog each other, bringing out their new products and releases. Cochlear, of course, had a product recall a year or so ago, so it's still selling a product that's about 6 or 7 years old. And you know, a lot of the market share has gone to Advanced Bionics during that stage. But I think it's a company that has delivered on technology in spades over the years, and it's one that we've always wanted to get into portfolios. I missed out on it the first time, and I don't want it the second, so we've started buying some, and we'll buy more if it falls further.
Well, exactly. Typical with a stock like this, when it falls, is you don't buy it the first time it falls, you don't buy it the second time it falls, but you buy it the third time, and we've seen the first fall and a little correction. What are your thoughts, Dave? Is it moving lower?
Well, it looks to me. It's found some big support at 69, which is the previous consolidation area where it broke out from and had this stellar run, which was back in September. Right now, if it breaks below 66, the next level it'll test is 69. If it breaks below 69, goes and tests 66, that'll be a good level. But if it breaks below 66, it's going down to 62. So right now, 69 is the line in the sand to watch this at the moment. If it breaks below that, 66 is the next level, and certainly be watching that as well. So
because the growth market for this stock is obviously China, isn't it?
Yeah, big time. I mean, they've just had their first contract awarded in China, you know, the technology behind the company is awesome, and they're also very quiet about new products that they're bringing to market. They don't sort of announce it until it's actually in the works. And you know, I think there are other things they're working on. We know they're working on the bionic eye as an example, which could be, you know, the next big thing. But for the moment, we're sort of happy to accumulate stock. And I think what David said there's right, is that, you know, if it came back to 66, we'd buy some more, and if it came back again, it's the sort of company I think you can be confident. Normally, I'm against that sort of thing. You don't want to buy the companies that are falling in this sort of market, but I think it'll, you know, down the track, and I'm talking a longer term sort of investment, you'll look back and think you're glad you did it. But I don't rule out a lower move in the shorter term. All
right, excellent advice there. It's time for a quick break, though, but before that, it's time to start the stock watch. David Novak, what are you watching? And your time starts right now.
Well, the stock I'm watching right now, I like, is a diversified minerals investment company called Cape Lambert Resources, CFE. A market cap of 158. They've got about 50 million cash in the bank, 85 million in receivables, and 44 million in other equities. So the company's trading below their liquid assets, but also the big asset they've got is Marampa iron ore asset in West Africa, which is worth $500 million. So this is a value play at 23 cents.
Welcome back to the program. If you just joined us, David's stopwatch was Cape Lambert Resource, and we were just talking about this, and David was explaining to us the what's going on in West Africa. So, Dave, elucidate.
Yeah, look, the main assets, see, they've had some problems with the ATO recently. You know, they had a tax amendment which they're disputing, and that's in, you know, that'll be going over a couple of years at least. But that's not a concern at all. I think that they've got some very good assets, and especially this one called Marampa in West Africa, where they've got about 698 million tonnes of iron ore, 28 Fe iron content. But the net value of that, the monetised value, the net present value of that from the scoping study is 1.45 billion net present value, but they want to monetise that asset. And they're looking at an IPO on the London Metals Exchange, or London, secondary market there.
Yeah, yeah.
To IPO that iron ore asset, and they're looking to monetise it this quarter, and they're putting a value of 500 million on it. Now, even if they get half that, that's twice the market cap virtually from where it is right now. It's come down to a key support level at 23 cents. It's trading back where it was in 2009, and this has come down from 55, 56 cents this time last year.
So is this Marampa resource got infrastructure like rail lines and ports and all that sort of
it's got excellent infrastructure. It's close to the coastline, but also they're looking at expanding that infrastructure down the line. As the CEO told me, this was last year when I spoke to him, that they're looking at selling off that asset, but they've got many other assets around there that are also excellent iron ore prospects as well. But the main thing they want to do is extend the rail line to the other prospects they've got, and actually charge a royalty to other iron ore producers, which would bring in a huge amount of revenue for the company. But that's down the track. Yeah. The thing is, it's a value play, and just based on their liquid assets right now, it's trading at a discount, but no value for that iron ore asset whatsoever after the scoping study. So
interesting play.
And they're also doing a share buyback as well on the 67 million shares left to buy, and 76% of the shares are held by the top 20 shareholders, and management have just got about 6.6%, and they've been buying the shares as well down here as well.
Okay.
So
interesting play to watch. All right, if you'd like to get in on the conversation, give us a call on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Our next caller is Max. Welcome to the program, Max.
Oh, good evening. Thank you for taking my call. My question relates to SMS Management and Technology. The code is SMX. It's trading at about $4.88 with a yield of about 6% fully franked, so that's taking it up to about 9% for a super fund. It seems very attractive. Most other yield stocks seem to have been overbought. I'd be interested in your comments. Thank you.
Okay, well, we'll see what we can come up with. Ben, have you know anything about this one?
Well, it had, where you see that big correction in the share price the fourth quarter, it had a pretty decent profit downgrade. SMX has previously had a very good reputation in the market, and I think that was a bit of a shock. We've also seen DWS, which is another one that's seen as a very sort of conservative, well-managed player, had not a downgrade, but certainly a weaker result than expected. And I just think at the moment you're seeing a lot of businesses cutting back on things like IT spend, which is where these guys make a fair bit of money. So, Rodney, I just think one thing you got... Sorry, not Rodney, the caller before.
Thanks.
Sorry.
Yeah, we'll scroll through.
I think you've got to just be careful when you're sort of looking at those yields, because if there were a second downgrade to follow the first one, the yield won't be what you're thinking it is, because they will have to cut the dividend.
Well, this is the problem with these when we're looking at historical yields and not forward.
And sometimes, like 6% fully franked, they could still pay that if that's the worst of it behind them, and they've sort of recalibrated expectations, and they deliver in the in this upcoming earnings season, very importantly, on what they told the market at the end of last calendar year, then you might see them start to get a bit of a re-rating. But I just think you've got to be careful about small to mid-cap stocks that have had downgrades and still trusting yields, because they can get cut pretty quickly.
What are the technicals telling you about this?
Look, it's not inspiring at all.
Not inspiring?
No, when I look at it, it's after that big plunge, it's just been consolidating, going sideways between about 450 and 520. Unless it breaks above and closes above 520, then it'll start a positive trend moving back up right now. But it's not one that I'd rush into tomorrow.
You've really got to know your P's and Q's with these small caps, don't you?
This industry, around that end of the year, I think about 4 or 5 of them within 2 weeks all have profit downgrades, and obviously there was just a crunch in terms of activity stopping very quickly, and they were pretty, sort of glamour stocks for a year leading into that. So again, expectations were high, and the actual results were low.
Roosted a feather duster very quickly. Yeah. All right, our next call is Rodney from New South Wales. Welcome to the program, Rodney.
Oh, how you going?
Not too bad. How can we help you?
Yeah, I just was after your view on Apple, given the current situation with David Einhorn suing Tim Cook essentially for return of capital to shareholders. I understand it's trading on a PE that's below its long-term average, and just for an Australian investor looking to invest offshore, what your view was.
It's an interesting question, because that's something that, I don't know whether you guys have been looking at it, but something that's been exercising my mind with Apple at these sorts of prices is that, it's fallen from 700 down into the, mid-4s. Is it worth buying at these sorts of prices? Forgetting what the currency's doing. I think it's on a price earnings multiple of about 9 or 10 times at the moment. 8 times, is it? Mm. It's got 100 and something...
137 billion, which is $155 in cash.
Yeah, so your thoughts on it? Would you have it as part of a trading portfolio? I mean, it's a bet on technology, and that's either going to be right or wrong, isn't it? There's no half measures with this.
Yeah, look, the thing is that worries me a bit is the trend at the moment. It's so weak. I mean, isn't it funny? This was the darling stock in the market, and this has been screaming down since September. Down to a low of about 440 not long ago. Still closed at about 462 last night. So I follow it very closely. It's come, like you said, with the cash, it's 8 times. Without it, 6 times earnings. But they're going to return $40 billion to cash to shareholders.
Yep.
Of course, it depends what happens with this dispute as well. But look, you'd have to say, is it good value? Yeah, but could it go down lower? Most definitely.
Well, the choice of technology at the moment is not Apple. It's obviously Google. So, it's almost like we saw Apple going one way and Google, sort of its rate of ascendancy was a lot lower, and then we've seen a switch, if you like.
Yeah, well,
and they all seem to have their day in the sun. But does that mean that Google's day in the sun is fast approaching, or is it, is it?
That sector changes so quickly. I mean, it's like every week there's something new comes out. So, the perception is with Apple these days is that they're going to be taken over by their competitors who are going to get more and more market share. I mean, their numbers weren't that bad. I mean, when you looked at their last quarterly earnings, they missed it by 30 cents, and the stock fell 14%.
Yeah, it's crazy, isn't it?
It's like, and then you get stocks like Netflix that had an earnings per share of 13 cents when they expected a loss of 13 cents, and the stock has rallied 80% in the last couple of weeks on 13 cents earnings per share to $180.
Yeah. Do you look at Apple, Ben?
No, covering their companies in Australia is enough work.
Right. Well, our next caller's got a question for you.
Yep.
Welcome to the program, Chris.
Hello, how are you?
Very well indeed.
Mainly a question for David. Took a tip from him a little while ago on Mountain Gibson Iron.
Yep.
Purchased at 66. They did get to about 90. Just wondering what he thinks. Should I sell them or keep hanging on?
Right. Okay. Hi, Chris. Well done buying them. Definitely not a sell, let me tell you. They're still cheap down here in as far as my valuation goes. I mean, especially for this next 6 months. They'll be reporting shortly. I'm not expecting a fantastic half-yearly report, but I've got to tell you, for the next 6 months, this stock will shoot the lights out. And it's fantastic value down here. And they're doing all the right things. Management have taken a 10% pay cut. They've got $300 million in the bank, which is a third of their market cap. They're paying a 5% dividend, fully franked on historical earnings. They've cut back, they're cutting back their costs. Iron ore is trading at 150. I mean, everything ticks the boxes here. So you'll see this will go up much higher from here, but be patient with it for the next 3 to 6 months.
This is one I think you also liked, wasn't it?
No. Look, I did say a few months ago I thought, there's value in this area, but we don't own any real sort of iron ore stocks other than, Hills and Rio.
Yep.
I still think, I totally agree that right now these guys are making very good money again. The thing for me is I've just got no idea what the iron ore price is going to do in the next 6 weeks, let alone the next 3 years. And I think they're just incredibly hard to value. And if the iron ore price stays at 150, Mount Gibson could be worth $1.50. I would have thought pretty easily.
That's the beauty of forecasting.
It is. I just think there are places in the market where it's easier to try and work out what the future holds for companies than this area.
All right, unfortunately, that's all we have time for today. So thanks very much to our guests and to all you, our viewers, for all your calls and emails. Thank you. Until next time, I'm Kim Slater.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Breaking the barrier, the ASX 200 passes through that key 5,000 point level for the first time in 34 months on earnings and that near 8% jump in consumer sentiment.